Hey everybody, it's good to be here. My name is Brent Moores, and it is time for managing an options portfolio. We do this each week at this time, and hey, glad you're here. So we're going to start off with talking about some options stuff in general, and then we'll focus on some positions we have in our options portfolio and discuss management of those positions. I'm joined by Connie Hill in the chat. Appreciate Connie always. I've been working with Connie for over 2 decades now. And so as you have questions, feel free to type those in the chat between Connie and myself. We'll do our best to get to those. Also, you can follow us on X at Brentmore CS, at Connie Hill CS, and for just additional content, financial related content throughout the week. Now, let me go through a few disclosures, then we'll get to the topic at hand. Uh, Options do carry a high level of risk and are not suitable for all investors, and multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and that doesn't happen on your paper money software application, which does not assign short options early, but just realize that's a difference between the paper money account, which is great, but it's provided for educational purposes only, and the real account, which is not just for educational purposes. I'll be using paper money today because everything we do today is for general, informational, and educational purposes only. And Schwab does not recommend the use of technical analysis as the sole means of investment research. I probably won't factor in commissions or fees in any trades we do, but just realize those are a factor to consider. All investing involves risk, including loss of principal, and past performance is no guarantee of future results. Hey, let's head on over to the Thinkorswim platform and see how we're doing here. Here's the S&P 500. A little bit of a bounce today after market got kind of whacked yesterday, driven by really the tech sector in general. Semiconductors especially got hit hard yesterday, and that's where we're looking right now. In fact, the kind of the headliner, I think, not in a good way, I guess, yesterday was Micron in terms of its drop. A lot of big movement on Micron. Today, down a little bit more even here on this. But the general trend, we're still holding that 20-day on Micron. And Micron's in the news where you have earnings coming out in about 4 hours on Micron here. So that could be big news tomorrow and could help to drive the market tomorrow. But one thing I want to talk about here today is implied volatility. I'm just going to add implied volatility on my graph. I have it quick linked here, but if you can always on yours just click on the flask up there and select implied volatility, and you'll see implied volatility. What's implied volatility? Implied volatility is just a measure of, and essentially, option prices. How expensive are those options? Well, what drives how expensive options are? Options are more expensive if people expect the stock we're looking at to move more. So if we expect a lot of movement, you're going to have higher implied volatilities, higher option prices. In other words, one way to think about it is right now, you can see Micron's current implied volatilities up here compared to where they've been back here. You'd say kind of high implied volatilities here, up over 100%. That's high, okay? That's very high for an implied volatility compared to the vast majority of stocks. Now, some stocks may be even higher, perhaps. Yeah, well, let's look at another one. I'll get back to Micron because I want to use that as an example here. Here's Wendy's. What's our IVs right now on Wendy's? 125% here on that. Okay. And so, boy, you can see the big move here on this. Do you see why expectations are big for this stock? This is kind of more of a meme stock type move here right now on this. Possibly short squeeze, high up almost $9 today, currently 763. Could this go back down to below, $6 or? Yeah, I mean, this could go way up, this could go way down. So options are going to be expensive, and our implied volatility reflects that. So just, that's what implied volatility is. Now, when we look at our portfolio and we have a column for Vega, or we look at an individual option chain and we look at Vega, Vega is just a measure of how much the option is likely to move. And it's an estimation, okay? It's just an estimation based on a change in implied volatility. And you can see I have various figures here. Let me just increase this column here a little bit so you can see it. You can see some are higher and some are lower. Most of these are kind of lower, $3-4 plus or minus. Long single options, long calls, long puts have positive Vegas. Short options, just a short put or short call, has negative Vega. Like Caterpillar is huge. I mean, this is way bigger than anything else. I guess we have Applied Materials has a fairly high Vega. What do we know about that? Well, I can guess when you see a super high Vega, it's either just a long call or a long put, single. Once you make it a spread trade, then they kind of cancel each other out and the numbers become much lower. So most of these are probably spreads for the most part, but you can see very high Vega. This could get hurt if implied volatilities drop. Same thing is true with thetas. Notice, look at the high thetas. Applied Materials has a very high theta. Caterpillar has a very high theta. Well, single options, okay? These are both long calls in this case. And generally, these are negative thetas, which you'd probably not love to see, but it may be worth it because maybe the benefit of just the long call, maybe the benefit of just the long call is worth the time decay that you're asking there, okay? So question, Sam, why is the instrument, I don't know why that's so wide, because at some point I made it so wide or something. I don't know. I needed it at some point, or when I clicked off and went on, it made it wide. But you can always adjust the width of these columns, by the way, if you want like that. I have quite a few columns on here. You can customize your columns, by the way. Just click on the gear and you can customize those columns. They're on this. But how do we traditionally deal with Vega? Traditionally, investors who are selling options look to sell when implied volatilities are higher. Okay, let me go to Micron. Here's Micron. They look to sell when implied volatilities are higher. And the theory is this, is if implied volatilities are higher, maybe they'll kind of revert to the mean. In other words, if it's high, it's more likely to go down. Or if it's at a low, extreme low, it's more likely to go up. And sometimes that happens and sometimes that doesn't. I mean, look, right here, we'd say implied volatility was pretty high compared to its history, but it's actually just gone up since then. But the theory is, if implied volatility is high and it goes down, that's going to benefit you if you sell options, okay? So IV high, sell options. That's kind of the traditional way people do that. And vice versa. IV low, you buy options. Traditional way you do that. Of course, we don't know what implied volatility is going to do going forward, number one. And Uh, Number two, there's a lot of other factors in there that can affect your option trades, right? Time decay can affect your option trade. The delta is usually the biggest factor here. In other words, the price movement of the underlying stock is usually the biggest factor. But that's how we normally do that. And so I want to just do a demonstration for that. But there's another important thing here on this. There's a reason why implied volatilities are high. Implied volatility is high is because people expect big movement in the stock. So if you expect big movement in the stock, I mean, ideally, if you're going to say sell an option, the stock, it doesn't move at all, or it just stays right where it's at or something like that. And ideally, at the same time, you have a really high implied volatility, but those don't really go hand in hand. Higher implied volatilities mean people expect a bigger movement. So it's not as simple as just selling a high implied volatility because we can get bigger movement. So what kind of movement could we see on Micron? Well, let's look. Here's the trade tab. Here's Micron. Here's your market maker move right now. This is actually down a little bit from this morning, right up there. Market maker move, plus or minus $100. Well, we have earnings coming out tonight. In other words, what the market is thinking is this is going to go up or down by about $100 through the earnings. Earnings is after close tomorrow, but so we'd say by maybe early, market open tomorrow. That's a big move. Okay, that's a big move. By Friday expiration, oh, hold on, that's not Friday. Let me get out of here. Let me just clear this out. By Friday expiration, $120. And as you go out, $500 by, what is that, August or something like that? So this is a big mover. So in other words, it's not as simple as just selling implied volatilities when they're high, selling strategies when implied volatilities are high. So because the stock can move a lot. Here's Micron. How much has it moved in the past? Go to the Analyze tab. Go to the earnings here on the Analyze tab. And you can see over the past. Well, here's the stock price. And if you're not familiar with this, the way this works is you'll see like a little dashed line. It may be hard for you to see right here, the little dashed line, but this is where earnings occurred. Right there's where earnings occurred, which is why you had a big move in the stock price right there. Here's where earnings occurred, which is why you had a big move down in the stock price right there. What about this column, this row? This is showing implied volatility, this row here. Are you guys familiar with this page here? Do you know how this works? This is what implied volatility. Here was implied volatilities before earnings, and then it drops. Okay. And you can see it if you just put your cursor there. Here is implied volatility in the red, 70%. After earnings, down to 45%. That's a, 25% drop in IVs? Let's check out this one. This is a past earnings. This is fiscal quarter 4, Q4 of 24. IVs before earnings, 62%. IVs after earnings, 48%. 62 to 48, what that's 14% drop? Look, notice they drop every time. I mean, it's not a guarantee it's going to drop tomorrow, but it'd be pretty surprising if it didn't drop tomorrow, implied volatilities. Now, notice, sometimes the stock goes up, sometimes the stock goes down. Implied volatilities drop. So implied volatility drop doesn't mean the earnings are going to drop. Excuse me, the stock is going to drop. Now, what about this yellow line? It's cut off here, but this is historical volatility. In other words, implied volatility is an expectation of the future. Historical volatility, which is in this yellow color, is what actual movement we've seen. Well, what happens after earnings comes out? Well, the stock usually moves a long ways. So if the stock moves a long ways, then the historical volatility is actually going to go up. So IV's dropping on earnings and historical volatilities jumps on earnings. We could do the same sort of thing. I'm not going to go through them all, but you could see historical volatility before earnings, 50%. After earnings, 69%. And well, you can see the movement in the stock. Well, what about today? What about no, this is currently. We have earnings coming up. Historical volatility is actually super high. Well, Micron was one of the biggest movers in the whole market yesterday. Yesterday, the markets got crushed. If you were watching the markets, you know that. You've seen that. And so just the amount Micron's been moving, historical volatilities are already super duper high. May go higher. In fact, there's a good chance they're going to go higher after earnings. Implied volatilities, and don't get tricked by this on this page. You can look down here and say, oh, this seems low compared to where we've been. But what really you got to pay attention to is what the number is. The number is 114%. So even though up here we see IVs kind of on the page, it's a little bit higher, it's actually half as high or less than that as to what it is here. It's just relative, okay? So there we go. How much is the straddle pricing? That I'm going to go through this quickly. Straddle pricing is just a way of giving an indication. It's an alternative way of having an idea of how much people think the market is going to move. In other words, if I take the price of my at the money call and my at the money put, and I add them together, that's going to give me an indication of basically what the market maker move is, which is right here. Okay? So there you go. Now, you can do the straddle pricing. That's great. That's no problem. If you have the market maker move, that's a quicker way of looking at that. So having said that, I'm going to put on a trade here. I'm going to put a trade on Micron. And look, if I'm looking at Micron and I am, of course, we don't know what earnings is going to do. Earnings can change this. We've had this upward trend. Is this drop is the drop that we had yesterday just, it seems from a technical standpoint that it's not that different than these drops, okay? Where the trend has continued up. Now, the difference is it all occurred in one day, but it's still within kind of the same magnitude here on this. And so, look, we're going to do this. Anytime you're trading before earnings, it's a little bit of just a lot extra uncertainty of where it's going to go. But what I can do is I can sell, say, a put vertical. Let me go out, 30 days. And I go to sell the put vertical. I'm going to use my delta, which tells me how much the option moves in relationship to a $1 move in the stock price. I'm going to get more strikes there because we don't have enough. And here's the thing. I can go down to, say, like a 30 delta, which kind of implies there's roughly a 30% chance, and these aren't guarantees, 30% chance that the stock's going to go in the money at expiration on this. This is, notice how far out of the money this is. 940. Well, the current stock price is 1045. So when implied volatilities get higher, you can go farther out of the money to get the same delta, 30 delta, and still a high premium. Now, and for example, let's say if implied volatilities weren't high, then the 940 would probably be showing a delta of, 10 or something maybe. We'd have to go up here to get a 30 delta, much higher. But by having the higher implied volatilities, hopefully those implied volatilities drop at some point, we can do this. So anyway, I picked about the 30 delta. Very often on these short verticals, we'll pick somewhere in the 30 to 35 range or something in terms of the delta. I'm going to go and I'm going to sell this. I'm just going to click on the bid price. I'm going to go down and I'll make it about $10 wide here on this. We did 965. I'm going to hold down my control key, click on the ask price. I said $10 wide. Let me do that. There we go. And what's our credit on this? $35 credit on this. $35 credit on this. Okay. All right. Let me go and I'm going to look. Now, that's putting it at the mid price. Probably not going to get filled at the mid price. So I'm going to move that down a little bit. I'm going to click on confirm and send, and I'm going to send this. Now, I just did something that some people won't ever do. Some people don't ever want to do, like, I'm not going to sell right before earnings. Earnings is just too uncertain an event. Fair enough. If you don't want to do that, don't do that. But to my prior point, if implied volatilities are high, then the traditional notion is you sell options. You don't have to. There are benefits of selling options when implied volatilities are lower as well. Okay. So let's look at this. I have just a list of stocks here. List of more liquid stocks. These are just stocks that have, I think, 8 million shares a day traded with penny increment options, something like that. Here's implied, I have an implied volatility column. So if you ever want to see like higher implied volatilities or lower implied volatilities, this is just a column you can add. These are all public columns, IV percentile, implied volatility. These are public columns. Just add the columns, and then you can pull up whatever watch list you want, S&P 500, Dow 30, whatever. I have this one. And you can just sort. Okay? Okay? You can just sort. So, there we go. That's that. Here is Nextera for 20 percentile. So that means if I look at this, let me click on it. This is low compared to its own history. Okay. Compared to its own history, it's low. Compared to the rest of this list of stocks, which is, I don't know how many are on it, 50 plus stocks on this. Okay. The implied volatility is near the bottom. Coke is a little bit lower. Could you sell an option on this? Yeah, you could. You're not getting as big a premium, but you're taking on less risk of movement here. This is like the polar opposite of Micron, which we just looked at. Micron, we're expecting very big movement and we're getting paid more for it. This, we're going to expect less movement. Now, sometimes you have something that where the market's expecting less movement, and all of a sudden, out of the blue, some news comes out and it moves a huge amount on you. Fair enough, that happens. But the market doesn't think so. All right? So here's Coke. Same deal. Okay? IVs are lower than, I mean, we were up at 27. It's down near 20. And so that's by most measures a relatively low implied volatilities. What are you going to see lower implied volatilities on? Well, stocks that don't move much, or like if you start to go to things like ETFs, which we're not really going to talk about today, or indexes, and you look at like kind of implied volatilities on indexes. Can you have an implied volatility on an index that doesn't have, you can't buy or sell? Well, yeah, they can have options. The S&P 500, for example, that's where the VIX comes from, implied volatilities on that. There's options on that. So you'll get lower implied volatilities typically on indexes, but there we go. I'm going to do I'm going to do another bullish trade. I'm going to do a similar type trade, short put vertical on Coke. Hopefully we can find something. We have some support kind of around this 79 level where we just recently bounced. That's where that 50-day moving average is. Let's see if we can match the technical analysis of the support, 79, with the probability analysis. Let me go out about a month here. We've got about a month. Well, maybe we'll go 23 days and see what we got. What price did we say? We said about 79 was our support level. Let's see if we have a 79. Is this our delta? Let me get rid of this column. Okay. Delta is 26. We can go up to 80, 35. We could also check. Let's go out 30 days and see. And we can go to 79, which is a 29 delta on that. So probabilities, which aren't guarantees, are saying that's about where we go on that. So I'm just going to click on that 79. I'm just going to do a 79, hold down my control key, 78. This is the mid price. I'm going to go a little bit lower than this just to try and get filled. And we'll see if this fills. I don't know if it's going to fill or not, but we're going to do that trade. This it's not filling yet. We'll see if that fills. Okay. So that is, if it does fill, that is a trade where we're actually doing a short option. In this case, it's a vertical spread. So implied volatilities aren't going to affect it as much as just a single short option. But we're doing a short option on something with lower implied volatilities, which is a little bit unorthodox. But I guess my whole point, I want to summarize before we go to kind of looking at other types of positions in our portfolio here. My point is, I think sometimes we oversimplify and say sell when implied volatilities are high and buy when implied volatilities are low, because implied volatilities are high or low for a reason. And that reason can affect the stock a whole bunch and the option a whole bunch, that if you factor in, you realize, well, maybe it's not always as clear cut as just selling when they're high and buying when they're low. Okay? So I'm hoping that makes sense. Hoping that makes sense to you, everybody. Now, of course, all these stocks that we look at have implied volatilities. I'm going to go back to my monitor page. I'm going to go back here and I'm going to just put these back in their groups. And I added a bunch of trades in yesterday so I'm going to skip a bunch that, like, I have some short verticals now. Of course, we just entered, I didn't put it in a group, but in fact, let me get rid of this. We just added in KO. Oh, it's not going to let me move the group because it hasn't filled yet. Okay. Micron, I'm going to move that to our short verticals. Short verticals. These are all trades that I just put in yesterday. Obviously, I'm not going to manage them after one day. Okay. So they're going fine here. Okay. Let's go to long single options. Applied Materials is new. I just entered that yesterday. I'm not even going to deal with that right now. Okay. Caterpillar, we mentioned already. It's a higher theta trade. So look, we're losing like 33 bucks a day based on just the time decay on this. Okay? Based on the time decay on this. Now, it doesn't mean we're going to lose $33 a day on this. Just similarly, just because we have positive theta doesn't mean we're making that money. This is just one factor of many. But has it been worth it? Yeah, this trade has been worth it. It's been going great because it's a long call, very leveraged trade, and the stock has gone up and we're doing well. We've been managing and looking at this for the last year, or some version of this for the last year. We've rolled it a few times. And it's certainly been worth the time decay. I mean, we've probably lost hundreds and hundreds of dollars because of time decay on this trade, but it's been worth it. So ask yourself, is it worth the time decay? And it may be. Okay, it looks like our Coke trade just filled. But we've certainly made a lot more than that on that. Okay, here's one where and I haven't, I have a note on this. We rolled this already. We rolled this for a credit on, I don't know what that means on that roll for credit on 56. I got to reevaluate that note. I'm not sure exactly what that meant. But so that one's been rolled, but we don't have a stop on this. Like we have a stop on Caterpillar. If you have a long call, well, not just a long call, but a lot of types of trades, but particularly long calls, long puts, short calls, short puts, consider a stop. Stops don't guarantee you're going to get out at a certain price. But look, we're doing okay on this. This is a long put, CRM. And let's consider a stop loss on this in case it reverses on us. So we're bearish on this. But look, this was kind of a support level. We broke through that. I'm going to consider that old support and new resistance. If we break above that, then I'm going to look to get out. Okay. If we break above that, I want to give it a little wiggle room. It's gone up a little bit. This could just be a bear flag. So we're going to let it go up to there, 167. We'll go up a little bit above it. Say, we'll go to maybe where our moving average is, 173. Let's put in an exit on that trade. Okay. So what I'm going to do, I want to get out if it goes above 173. Now, that's the stock price, 173. This is an option. So I could also put in an exit based on the option price. Look, I can just click on this, create closing order, sell it, and say, if this price goes from $9 down to $5, I'm going to get out or something. Perfectly acceptable to do that. And if I were to do this, we'll just do what I just mentioned, $5. You can look right down here, and the expectation on the price is about 161 on that. Okay. Now, we said, how low would this be at 173? Well, hold on. Maybe this isn't even worth anything at 173. $3. $1. And this basically is worthless at 173 if we get out at 173. According to this model here. So in that case, it may be too far to go. I mean, there's no point having to stop if the option's already gone worthless on us. So I'm going to do with what we said before. I'm going to put that in at say $5. I'm going to do this as a traditional stop on this. Stops don't guarantee we're going to get out at $5 or whatever price we put. It turns to a market order at that point if we just do a stop. Sorry, order, that's a limit right now. Let me switch that to stop. Hold on, let me get my drawing tool. Stop. Okay. And I want that good till canceled. I have that there. Doesn't guarantee we're going to get out $5. Now you may be going, I don't want to lose $5. That's excessive. Or no, I wouldn't be losing $5 because it's $9. I don't want to lose $4 or $400 on that from where we're at. When you're doing long options, they're leveraged, they move quickly. You can't have them too tight if you want to stay in the trade. We could always just get out and take our profits, but I'm going to stick with this and put that, I'm going to put that trade in and confirm and send, and I'm going to send that. And now what we're going to have here is you have that little tag next to that. This just tells us you have that stop price on that. So when you have long calls, long puts, consider at least adding a stop order, even though you know it's not guaranteed. All right. Now, this is a shorter term trade. We're taking advantage of a shorter term move down. Bruce said, hey, this is looking like an attractive stock at this price. Remember, there's a lot of different ways to trade. We can trade shorter term options. You can do longer term options. You can do longer term stock. Bruce is referring to buying stock. And maybe you do a fundamental analysis on this. Maybe you think CRM, Salesforce, is going to go up in the long haul. Maybe this is a buying opportunity. Different types of trades. Okay. Long verticals. I don't have anything that's not brand new in our long verticals category. And same thing with our calendars category. Just entered a bunch yesterday, so I'm not going to do anything with that right now. Now, let's look at some of these. Move this down and go. I have various stocks here. I have on CNP, what's this? I have long stock, short call. This is the covered call. Now, we still have plenty of time on this. Okay. So look, if we're getting near the expiration, we don't want any assignment risk or there is assignment risk always, but we don't want to heighten the assignment risk by holding us near expiration, particularly if it's in the money. The stock right now is at 40, a little bit under 44. Our call is at 44. We're down a little bit on this. Obviously, the stock has done well for us. We're trying to pick up some time decay and take advantage of it staying below that price. Well, it's not. The call portion isn't doing that great. Question is, do we stay in it? Let's look at CNP. One sec, CNP. And so we're kind of banking on, this is what we're hoping. Hopefully this goes way up, to be honest, because we have the short call, but we also have a long put, a long call. We have long stock at the same time. And we can take advantage of that. But look, for the short term, ideally, this kind of goes like this until we get out of our call, or it goes down until we get out of our call, and then it goes way up. That'd be the ideal situation, okay? So remember, we have the stock. Stock's going to be 100 delta. We have the call. I don't know what the delta on the call is right now, but it's probably somewhere close to 50, negative 50. We're still a net positive 50 delta. In other words, this is still a bullish trade on this right now. But the question is, do we stay with this call, this short call? Well, here's what I'm going to say. I'm going to say as long as we stay below here and we expect it to kind of go sideways, we're going to stick with that call. We have 23 days to go to expiration. Now, you could say, I'm starting to get bullish on this, Brent. And if you're starting to get bullish on this, then what you'd probably do is you'd probably buy back the short call. You could buy it back for just a little bit more than you sold it for up front. So you're taking the small loss on that. But then we're unfettered, so to speak, on the stock there. So you could make either decision on that. I'm going to let that sit though, and we'll look at it again probably next week. I have CSX. What's CSX? We're losing money on CSX. You see this trade? This is a synthetic. How do you manage synthetics? Well, think of what synthetics are. Synthetics are trying to simulate stock ownership. Okay? Trying to simulate stock ownership. They aren't stock ownership, right? There's differences between this and stock ownership. One thing is this has an expiration date in 58 days. But if I owned CSX stock and I got in presumably because I was bullish on this, I have an exit on this. Okay. See if I mark that. Exit below 44.50. Let's look at CSX. CSX. Exit below 44.50. So right about here. Am I bearish on this? If I'm bearish on this, if it were a stock, I wouldn't want to hold on to it. But in my mind, this isn't that bearish. We're not, this is still, our general trend is still going up. We do have this kind of mini lower high, excuse me. But we bounced off the 50-day. So I'm going to maintain our bullish posture on this. We're going to let that sit, okay? So, but if you do turn bearish on it, then you just get out of the whole shebang. Okay. We're not going to have time for much more, but here's another one I want to look at. Delta. I just have stock on Delta. Delta, well, helps if I pull up Delta. Delta's gone way up. What has it done? I mean, this, I'm sure oil prices getting lower probably helps Delta right now, but it goes up and down, up and down. It's gone up. I don't think it's unreasonable to expect that it may go sideways or down a little bit. This may be a time to sell a covered call. So one thing you can do is, of course, you can look and say, well, I want to look at, say, an RSI or something on there. Oh, we're overbought on that. That may be a time where some people look to sell a covered call. So stock's at 90 right now. It's already had a pretty good run up. If we think it may rest a little bit, settle a little bit, then we may look to sell a cover call on our existing stock position on Delta. Doesn't need to go out very far. I'm going to just do 23 days. I'm going to go out and let's just see what kind of returns we're getting. Stock's at 90, almost like right on the nose there. We could sell a 95 call, 35 Delta, $229 at the bid. We could probably get a little better than that, actually. Sell that and confirm and send. And then that's going to go in our long stock covered call category. And I'm going to send that. Okay. So we now have a covered call on that. Limiting our gains shorter term here, 23 for the next 23 days. But if it does go up to 95, not terrible. Originally we bought Delta at 56. But I think most technicians would probably say, look, in the short term, it's probably not going to do that right now. It's probably more likely to do this and then move up. And then this is where we look to exit that trade. Okay. So, but I don't know, I'm not sure what it's going to do here, but that is more in character with the flagging pattern that we've seen on that. All right, everybody. I want to thank you for joining me. Reminder, tomorrow evening, we have a market outlook, the Schwab market outlook. That is tomorrow evening. Okay, so keep an eye out for that. You can watch that on this Trader Talks channel. Make sure you subscribe, Trader Talks channel, so you don't miss stuff like the market outlook or other webcasts. If you like, and by the way, Connie put a register link for that market outlook in the chat. Thank you, Connie. I appreciate you. Not just for that. Thanks for your other help in the chat today, Connie. Always appreciate you. If you like the webcast, I do appreciate a thumbs up, and that helps to promote the webcast, and it helps me. So I do appreciate you. But I thank you. Coming up next, we have trading price patterns. We'll be back next week, different topic, but still looking at managing different types of trades at that point. So everybody, thanks for joining me. Have a wonderful rest of the day. Bye-bye, everybody.